The optimal policy response to these stability challenges will vary between countries depending on the depth and level of development of their financial markets and on the degree of relevant financial vulnerabilities. Now, in my talk today, I will explore how global economic challenges affect stability in small economies and discuss the measures that can be taken to mitigate their adverse effects. Now, I come from the central banking world, and that is where I will begin by looking at the challenges posed for macroeconomic and financial stability by cross-border financial integration and fluctuations in capital flows to and from small economies. Now, although I was the governor of Central Bank of Iceland for a decade in the crisis and after the crisis, I will not mention Iceland at all. I will talk generally, but what I say is very much influenced by my experience as a policymaker, but also my own research and publications, and it goes back to the time when I was the deputy head of the Monetary and Economic Department of the Bank for International Settlements. Now, it is widely accepted that cross-border financial integration provides potential benefits for participating economies in the form of risk diversification and economic development. But in recent decades, it has been increasingly recognized that it also comes with significant risks for financially integrated small economies. Now, not all small economies are financially integrated. Some of them have closed capital accounts, but I am talking about the financially integrated. Now, the risks derive from the influence of global financial conditions on the domestic financial conditions in these economies. And these are manifested in two ways. The first comes from the effect that cross-border financial integration has on interest rates and other financial asset returns in small economies. Now, theoretically speaking, full financial integration implies that expected risk-adjusted real returns on similar types of financial assets will be equal in any two or more fully integrated markets. Our world has less than a handful of big economies with international reserve currencies and a multitude of small economies, which have at best a minuscule effect on global financial conditions. This has the implication that cross-border financial integration of small economies, as that becomes stronger, the more longer-term interest rates in those economies become pegged to longer-term interest rate in these big economies. I say pegged, the level might differ, but they move in the same way. As a result, the transmission of domestic monetary policy in financially integrated small economies through the so-called interest rate channel becomes significantly weaker and in the limit fully blocked. The implication is that the transmission of monetary policy to the real economy will be shifted from the channel where central bank rates affect long-term interest rates to the exchange rate of the currency and other channels. Now, if the exchange rate is well behaved, in the sense that it moves smoothly in line with underlying economic conditions, or so-called fundamentals, then monetary transmission through the exchange rate channel can work reasonably well. It is here, however, where the problem arises, as there is a significant body of empirical evidence to suggest that exchange rates are often far from being smooth reflections of underlying fundamentals, with foreign exchange markets exhibiting excess volatility and exchange rates diverging from fundamentals for protracted periods. Such disorderly exchange rate adjustment can have detrimental effects on export and import competing sectors, but more importantly, it can create big risks for financial stability in those small economies that are burdened with financial vulnerabilities in the form of significant currency mismatches and foreign exchange maturity mismatches in domestic balance sheets and income flows. The other way that risks from cross-border financial integration manifest themselves is through synchronized fluctuations in capital flows to and from small economies due to changes in global financial conditions. Several relatively recent studies have provided rather convincing evidence of a global financial cycle with the U.S. financial conditions as its main driver. This financial cycle, is behind these synchronized fluctuations in capital flows, which are to a significant degree unrelated to domestic conditions in the small economies. These fluctuations can therefore cause unwarranted and unwanted changes in domestic financial conditions in the small economies that give rise to risks for macroeconomic and financial stability, especially when economic and financial cycles in small economies are out of sync with the global cycle. How serious is this problem? The answer is that it can become very serious, as history has shown that the interactions of fluctuating capital flows and disorderly exchange rate dynamics, the interaction of this with domestic financial vulnerabilities can result in financial crisis in small economies if it is left to run its course in the absence of policy interventions. There are, however, different and countervailing tendencies at play here. More integration means more risk, but less financial vulnerability means less risk. Looking across countries, we see that the most integrated small economies tend to be less financially vulnerable and are more likely to be advanced economies. Furthermore, the level of cross-border financial integration around the world has changed through time. It peaked just prior to the Great Financial Crisis, 2007-2009. It then reversed somewhat as capital flows turned back to big reserve currency economies. Cross-border banking partly retreated to home base, and restrictions on capital movements were in some cases reintroduced. It had since come partly back, especially in advanced economies. These changes over time, in combination with the global financial cycle, partly explains the feeling in small economies, especially the emerging markets ones, that the challenges vary significantly from one time to another, as they are sometimes faced with strong capital inflows, which give an expansionary impulse to their economies, followed by capital outflows that have a contractionary effect. It is during such extreme fluctuations and when financial vulnerabilities are present that risk to financial stability can accumulate and in the limit result in a financial crisis. Now, small advanced economies with relatively deep financial markets and sound financial institutions have a bigger capacity to absorb capital flows without putting financial stability at risk than other more financially vulnerable economies. But even for them, surges in capital inflows can be a nuisance and complicate macroeconomic management. The reason is that capital flows can in certain situations make some traditional instruments of macroeconomic management almost unavailable for internal stabilization. The classical example of this is when an economy is faced with strong capital inflows that put downward pressure on domestic interest rates and upward pressure on the exchange rate at the same time as the economy is overheating, the exchange rate is overvalued, fiscal policy is already countercyclical, and foreign exchange reserves are ample and costly. The dilemma in this case is that higher policy rates that might be needed to reduce demand pressures will suck in more capital inflows. The options here are to do nothing and live with it, or to consider additional instruments. The optimal policy response to these stability challenges will vary between countries depending on the depth and level of development of their financial markets and on the degree of relevant financial vulnerabilities. For most emerging market economies and the more vulnerable small advanced economies, the response is likely to involve a departure from inflation targeting monetary policy, with the policy interest rate at almost the only tool, micro supervision of banks and the financial sector, and let then the markets do the rest. More instruments are therefore needed, and a managed float of the currency rather than a free float, where instruments are used in the managed float to avoid misalignments and excess volatility, a managed float rather than a free float. The additional instruments for non-crisis situations could include foreign exchange interventions and targeted capital inflow management measures. The big picture is that individual economies have dealt with these challenges in ways that are broadly consistent with their structural characteristics. Big advanced economies and several smaller advanced economies have opted to live with them and stick mostly to freely floating exchange rates and abstain from using capital flow management measures. Some advanced small economies have, however, used foreign exchange interventions more actively in recent decades, and a few have used temporary capital management measures. Finally, emerging market economies have been more active in using both foreign exchange interventions and capital flow management measures. There are at least 3 ways to improve more durably the trade-offs that small economies face due to cross-border financial integration. The first is to enter a viable monetary union. With such a move, the small economy becomes big in the monetary sense, because its currency is a big player. And therefore, exchange rate instability and currency mismatches become less critical. However, apart from the small economies in the periphery of the euro area, most small economies around the world do not currently have that as a realistic option. Furthermore, a membership in the euro area presupposes a membership in the European Union, which involves considering pros and cons in many other areas. The second way is to develop more efficient and deeper domestic financial markets, which would increase the capacity to absorb capital flows. This is widely accepted and has been embarked on by many emerging market economies. But this, as many other structural reforms, take time to implement and deliver their benefits. There are furthermore limits to how deep foreign exchange and other financial markets can be in small economies. The need for additional macroeconomic and financial stability tools might therefore remain. The third way is reforms to global economic arrangements that would reduce the risk for small economies from cross-border financial integration, as a result, they would be less forced to self-insure with big foreign exchange reserves or tinker with free capital movements. The list of such potential reforms includes measures that are highly unlikely anytime soon, such as an international monetary system that is not based mostly on one domestic currency, or that big reserve currency economies take cross-border spillovers and spillbacks of their macroeconomic policies, especially monetary policy, into account. Not very likely at this moment either. But the list also includes reforms where there has been some progress in recent years, such as stronger global financial safety net at the IMF and other places, and international and regional arrangement for foreign currency liquidity support. The challenges that small economies face because of the financial global cycle and fluctuating capital flows is one example of several in the last few decades where small economies have had to deal with the consequences or adverse episodes that have had their origins outside these economies. These episodes are the Great Financial Crisis that had its main origin in the financial sectors of big advanced economies, the COVID crisis, which originated outside the economic system, the recent inflation shock that partly had its source in policy mistakes of major central banks, which was then compounded by bad luck, and now this latest episode, which has yet to have a fitting and accepted name. These events show that our ability to predict and prevent is far from perfect, which puts a premium on resilience and general preparedness to deal with multiple known and unknown sources of shocks. For small economies, that implies adequate buffers like foreign exchange reserves and bank capital and liquidity, good regulation and supervision of financial sector and financial vulnerabilities, and macroeconomic policy space. Regional alliances and better global arrangements can certainly help, but currently we seem to be going in the wrong direction regarding global economic arrangements. Let me stop here.